6% default rates on high yield bonds there. Is that something you can live with? And also at the same time, if we have a look at what's happening in Asia, we can see this premium developing here. We've got a chart showing exactly that. We've also got many other financial institutions, such as Goldman Sachs, seeing an opportunity in Asia's junk dollar bonds, which of course have been lagging the US, as this chart shows, despite a recent rally. So what's your take on all this?
Thanks for having me, Rich, and good morning, everyone. So definitely 6% is not an ideal default rate when we live in the high yield investing world. But I would say that, first of all, in terms of valuations, 6%, if it's justified with the current credit spreads, then it's not something to be fearful of. And we have to consider that in high yield investing, we still have different choices in industries and credit ratings. So in terms of interest servicing costs, we are going to get support from the global central banks with low for longer interest rates. And if we can be selective in terms of credit fundamentals and be selective in industries, I think there is still opportunities to be explored. And as far as Asia is concerned, our default outlook is actually more benign than the 6%, which actually valuations is more than compensating for that default right now. So in Asia, we are seeing faster than expected economic recovery, especially led by China. And as this divided Congress is actually turning the gridlock into a Goldilocks situation with low for longer interest rates and pro-risk assets development, we are seeing that the Asia high yield market is presenting very distinguishing value to us at this moment.
And actually, but where are you finding that value? Of course, you have to look at it through credit analysis. And what are you seeing? What industry groups do you like here? Which are the ones you're staying away from, for instance?
If we talk about Asia high yield, for example, definitely a lot of that from the high yield is coming from China, and especially from the real estate sector. We do have a relatively bullish view on this sector still, based on the fundamentals from broad Chinese economic recovery, as well as the valuations are still cheaper than historical average. At the same time, certain industrial sectors, as well as certain local government funding vehicle sectors, they will be suffering from the certain economic slowdown, and as well as uncertainty or intransparency in terms of their corporate structure. So those are the sectors we would like to avoid right now, but we are still focusing on Chinese high yield properties.
And have you seen an increase in appetite for Asian high yields post-election?
Definitely. I think with most of the election uncertainty out of the way, or at least we are expecting that this divided Congress will prevent certain drastic policies, restrictive policies out of the US, we are focusing on the economic fundamentals, valuations, and technicals. And especially against this backdrop of lower for longer interest rates, we are going to see this chase for yield driving inflows into Asia, where economic fundamentals are still leading the broad emerging market. And the overall emerging market will be benefiting from an expected weaker US dollar outlook.
Do you think, Anne, that emerging market dollar bonds can withstand the spike that we're seeing in terms of yields in the US?
We can. So emerging market, as I said, will benefit from weaker US dollar and will benefit from a lower for longer interest rates. So at the end of the day, emerging market is where people are still being compensated for taking the credit risk. And as long as the credit spread justifies for that risk we're taking, and we would be we would still be very strong advocates of this asset class.
Just looking at the sovereign picture here as well, we've got Chinese 10-year bond yields rising and treasury yields surging as well. Is this surge in sovereign bond, is that rally in yields sustainable?
Well, first of all, we like Chinese assets. We think Chinese assets will serve as saving asset purpose going forward, given the low correlation with global risk-free assets. And PBOC is probably one of the few, if not the only one, central bank from major economies that still has the room to ease. However, I would say PBOC would probably determine their policy stance going forward more on a judging the domestic economic recovery, as well as they are going to gauge the incoming U.S. government, how they're going to cope with the new geopolitics or foreign policy perspective. So I think the PBOC would be more adopting a wait-and-see approach before the end of the year or before the power transition.